Our first company tonight is Zephyr Energy, who are rapidly growing the business with a series of accretive deals. Colin and the team are delivering a buy and build strategy in the Williston Basin, developing a non-operated oil and gas portfolio there. And the latest proposed deal for $36 million of Williston Basin assets is to be paid for by a £12 million placing and also a $28 million debt facility. The plan, more or less, is to use those non-operating revenues to pay down debt and to drill and further explore their main asset, the main game, which is the Paradox Basin in Utah. I'm sure Colin will tell us all about that tonight, but we're so delighted to have you live once again from the United States.
Well, thank you very much. I appreciate that. I think you got the story right there. I'm not sure how much more I need to tell, but
we'll just stop there, shall we?
Yeah, absolutely. Well, thank you, Donald. And thanks to everybody watching. I'm cognizant that people are taking time out of their evenings to spend here with us tonight. So we appreciate that and don't take it lightly. Let me go ahead and tee up the slides here. Tonight, I know most of you or many of you will know the story already, but for those of you who don't, we'll give a quick corporate overview, walk you through the two key parts of our company, which are the non-operated portfolio and the operated asset that provides most of our growth. Walk you through some of our thoughts around ESG and steps we're taking there, and then give you an overall summary. Before we get into it at all, though, it's always important. I always try to cover this right up front. We are a company that was founded on two core values, two key principles in pursuit of one ambitious goal. Those core values are to always be responsible stewards of our investors' capital and to be responsible stewards of the environment in which we work. Using those as a framework, we are going after our goal, which is ambitious, but we've made excellent steps over the last 2 years to get there. And that is to open up the next prolific onshore U.S. oil and gas resource play. I'll walk you through how the combination of our assets help us pursue that one key goal. So we're an oil and gas company, 100% focused on the Rocky Mountain region in the US, and we do everything, all of our development, through a carbon neutral lens, which is very rare in this industry, as you know. We're developing a significant operated asset in the Paradox Basin, Utah, and we also own a series of non-op interests in the Williston Basin, which is North Dakota and Montana. I think of the company as two pieces. They're the growth assets, which are the Paradox Basin. We have 37,000 acres, a majority of which has 3D seismic and extensive data from underneath that seismic, logs, cores, pressure test data, and recent production test data from a well we've just drilled and tested. This production test was hugely successful, so much so that we were constrained at the facilities from producing it at its peak. But we got over 1,000 barrels a day of oil equivalent from that first test. This was the first time a modern hydraulic stimulation of a horizontal well was used in the Paradox Basin. We think it was a great proof of concept to open up a wider development across 9 reservoir zones and across the 1 billion barrels that we believe is in place under our leasehold alone. So that's our growth side. Underpinning that is our value strategy, where we have been making non-operated investments in low risk, high margin wells in the Williston Basin. We focus on production and near-term drilling opportunities. We look for production with low acquisition costs and very high margins. And in this environment, certainly that is very achievable. And we use the cash flow from that business to fund additional Paradox drilling or to do additional acquisitions in the Williston. We completed 4 acquisitions in the Williston last year. We've got the 5th and largest one that's scheduled to complete mid-February. Right now, this portfolio is 15 wells, about 650 barrels a day, and that number is growing. When we complete the Kaiser acquisition in mid-February, we'll have over 1,750 barrels from the non-operated portfolio alone to dovetail with what we do in the Paradox. As Donald mentioned, we just did a placing to fund this acquisition and to fund additional drilling CapEx and some infrastructure and equipment costs in the Paradox. We issued just under 13 million pounds of equity that will go alongside a plain vanilla reserve-backed loan of 20 million pounds, just over 20 million pounds, to help facilitate the production acquisition that we're doing. In terms of where that leaves the company, a corporate overview, closing price yesterday was just over 5p. That gives us a market cap of about 69 million pounds. Pro forma, when the second tranche of the placing is brought in, the pro forma market cap will be just shy of 80 million pounds. We've grown this company to date without using any debt, but as part of this acquisition, we will we'll have about $32 million of total debt outstanding initially. And it's always been important, very important for the board to lead with its own money. We have bought 10% of this company to date. We participated in every single round and in bridge funding to get this acquisition. Unfortunately, we couldn't participate in this latest placing because we have a competent persons report coming out and we have knowledge of what's going into that. So we were prohibited from investing in those most recent round, but we certainly will continue to support the company in the future. There's also $16 million of tax losses, which offset production income, which we'll be getting from this acquisition. So 2021 was a formative year for us. Very proud of the fact that we developed and designed an offset of all of our carbon emissions from operations. Really, to me, was the first of a kind. We do it through the purchase of verified emission reduction credits. It is key to our strategy here. We had a hugely successful first production test in the Paradox. We closed 5 acquisitions, which resulted in a 50% increase in our acreage in the Paradox, as well as growing from 0 production at the beginning of the year to over 650 barrels at the end of December. And that's in addition to averaging about 700 barrels a day from the production test in the Paradox. And the result of that progress was we were the top performing company on AIM last year. We're very proud of that, but we are not resting on our laurels, and hence the acceleration into 2022. We are raising funds which will be deployed directly into accretive investments. This is not going to fund G&A or overheads. These funds will be deployed in a judicious and very accretive way, and we're looking forward to starting that shortly. A quick note on the team, just a few people to point out here. Rick Grant is our chairman. He used to run one of the world's largest natural gas infrastructure companies. He is going to be hugely helpful as we develop our relationships with infrastructure and gathering system owners in Utah. Gregor Maxwell, our head of subsurface, has really been spearheading the Paradox development. He comes out of Apache and Chevron and brings a very critical offshore mentality to this onshore project. And it's why we've been so systematic and careful in developing this. James Lee and Caleb Dasinger are new to us over the last year. They've come out of a private equity-backed firm that was developing a portfolio of non-op in the Williston. They've been hugely helpful and boots on the ground as we build up the non-op strategy. So let me run you quickly through the new acquisition and where we are today in the Williston Basin. This is, again, all non-operated, a very core basin in the U.S., one of the largest basins in the U.S. We have currently 15 wells there, just over 650 barrels a day of production in December. We've got 7 wells in the existing portfolio that will be coming online over the next 6 months. You can see to the right here on my screen, the shaded blue boxes are areas in which we already have interests. And all of the blue lines and red boxes are coming with this latest acquisition, the Kaiser acquisition. It really fits hand in glove with our existing portfolio, which is one of the reasons we're very excited to close this. So we will be acquiring interest in 228 wells. They're all operated by Whiting Petroleum. This is a very oily package, low risk, large PDP base, great wellbore diversity, and we're paying just over 2 times EBITDA for this. For those paying attention, you might have seen that Whiting today announced an acquisition in this same exact field of non-op interests. And we think our valuation stacks up very favorably against that mark today. So I'd encourage people to go look at Whiting. So we will be bringing in 163 producing wells and a fair number more to come online over the next year. Average working interest is about 4%. And in terms of margins, these are low operating expense wells, you know, under $15 a BOE, so margins of over 75%. This is our reserve summary done by an independent reserve consultant, and this was done in November pricing. And this combines our non-op portfolio, what we've put together over the last year and now. Just focus on the bottom right corner, the 59 million of total proved reserves, and most of that's PDP. That number will be significantly higher now with good pricing, and it's really the underpinnings of support of value for this company. So it's what we aim to use to then grow the Paradox and accelerate our efforts there. On the Paradox, I know many of you know about this. It's a large acreage position, 37,000 acres. Zephyr and its predecessor have been active there since 2014. We just got approval for a new federal unit across much of this acreage, which helps us hold it in perpetuity as long as we're active there. This was historically a natural fracture play. It wasn't developed using any hydraulic stimulation or horizontal wells. Produced about 10 million barrels to date, but some sporadic results because there was poor seismic across most of it, and really was overlooked during the last decade when other basins such as the Permian and the Williston were moving from what had been old vertical production and moving to a resource play very successfully. We think this has the opportunity to do the same thing. We have very recent seismic, extensive log, core data, production test data, pressure test data, and it's given us the confidence to move forward and accelerate our efforts here. We also have a unique partnership with the U.S. Department of Energy and the University of Utah's Energy and Geosciences Institute. This gives us not just great access to research and academic tools, but we've also received a grant to drill a research well here of $2.1 million, which we did last year, and that helped us gather the data and the confidence to move forward with this play. I think what everybody's interested in is the recent drill that we've completed off of that research well, a long lateral, 4,000-foot lateral, and a highly successful production test. As I mentioned, it came on at over 1,000 barrels a day peak, and our modeling suggests when the constraints are removed at the surface, this could plateau at above 2,100 barrels a day. So based on this, we are going to go in and do 3 additional wells. One targeting the same reservoir on a different piece of acreage to delineate it. One to the south of us in the historically prolific Cane Creek field, which again hasn't had modern stimulation or horizontal wells combined across it. We think it'll be very applicable there. And we're going to target a well in one of the shallower overlying reservoirs as well. Assuming success here, this would give us at least 150 additional locations across 9 reservoirs to target. Significant scope. It's a lot of scale that we could unlock with success from the next 3 wells. We are considering lots of ways to fund this and to accelerate the development here. We're in a very good position now with the latest funding. We could do this all internally off of our own balance sheet. We're also obviously always look at partners and strategic partnerships if that's better for our shareholders. Drilling highlights and what we've learned. We sidetracked off the existing vertical research well. We were able to go a lateral of about 4,500 feet. Laterals in the future will be longer. We did a small pressure test, an injection test, and then a large stimulation of this. What we've learned through the drilling of these, both the vertical and the horizontal, is that we have hydrocarbons, not just in the Cane Creek target, but in all of the reservoirs above. We've high-graded 8 of those overlying reservoirs. We have excellent formation pressure. This is a highly pressured area, which is strongly positive for reservoir drive, combined with permeability that's consistent with or better than other U.S. prolific plays, like the Williston and the Permian. It's very exciting what we've seen. There are still risks we have to manage. That includes managing the pressures here, understanding the fluid type and how that evolves. But we're extremely happy with what we've learned so far. This first well will be tied in later this year. It can be, we think it'll do around 10 million cubic feet a day and 500 barrels of oil a day of liquids to average about 2,000 overall. In terms of the overall play, we see excellent geologic conditions to continue this style of development, hydraulic stimulation. The liquids that we've seen here are a high API condensate. It blends really well with heavier crude that comes from other parts of the state. We think it'll get a premium to WTI. We know it'll get a premium to WTI at the refinery, but there will be trucking costs to get there. So we're modeling right now slight discount to WTI in our economics. We also have a significant amount of gas volumes. There is infrastructure that runs across this field. There's a new owner of that infrastructure who's a large utility that will be doing some rehab work there shortly. We will tie into that infrastructure long term. In the meantime, there is a phenomenon that's sweeping across the E&P industry at the moment, and that's co-location of crypto mine facilities. It's hard to think, even a few years ago, that you would see crypto mines and stranded gas players working together, but that's what we're seeing, and we have a perfect location for it. There are other operators in our basin doing this already, and we think it's a way to get the well producing earlier than the end of the year, and being able to generate both gas volumes sold to the crypto mine and liquid sales as well. I'd like to walk through this idea of crypto mining just a little bit more, because I know it's slightly odd, but or unusual in this industry, but it's really just energy infrastructure. You're taking a locally produced commodity, which is natural gas, you're converting that to power, you're converting the power to a different globally traded commodity. The reason we're seeing so many producers doing this right now is there's a big movement in the Biden administration as well to limit gas flaring and reduce emissions. So the pairing of lots of crypto miners who have come to the US, it's more than a third of all crypto mining right now, paired with these environmental concerns means that there's a real opportunity to co-locate mines and sell gas. We're not stepping into this blindly, though. We put together a really good team to help us source this, including Jacinda, who is a 20-year geologist in the Paradox Basin and has spent 4 years setting up mines. We have Zach Fallon, who was a leading attorney at the SEC, who's helping us on the regulatory front now that he's in private practice. And Will Mapp, who's a cryptocurrency developer, noted author on tech issues, and has been really helpful in setting the lay of the land for us. So lastly, just to touch on our overall philosophies, we are carbon neutral. It's incredibly important to us. There's a cost from being carbon neutral. We're averaging under $1 a barrel for buying these credits right now, but we're also seeing some economic benefits on the side of being able to sell at a premium price those volumes that are considered carbon neutral. Beyond that, it's just the right thing to do. We're obviously global, oil and gas are in global common usage. We think we can have an impact by making that production of it more friendly from the macro standpoint. Micro standpoint, local considerations, we're also very focused on maximum resource recovery with minimum of surface disruption. And by developing this as a hydraulically stimulated resource play, it'll allow for multiple wells on a single pad, minimizes surface disruption. We are miles from any local town or community, so there's zero traffic noise, air emission, or water table impacts. This is a very good place to both develop an oil and gas play as well as to co-locate crypto mines. So that's a lot of information. Where does it all sum up? We have a portfolio with the closing of this deal that has a huge amount of organic growth potential. To date, we've delivered creative solutions to de-risk that Paradox portfolio and to grow the value, whether it's the grant funding or whether it's how we've built out the non-op volumes, which then kind of accelerate more cash flow back into the Paradox play. There's growth potential on both sides, but the Paradox alone, and I'll reiterate this, we see 1 billion barrels of oil equivalent in place. Even with extremely conservative recovery factors of between 5 and 15%, in a success case here, we see at least 150 wells to drill. And this 3-well program at the end of this year could lead to a significantly larger program next year. All of the cash flow numbers we talk about so far are really just from the non-op, but this will have the ability to augment that significantly. So next steps for us. There's a fair amount of upcoming news flow. We're going to close the Kaiser acquisition on or before February 18th. We have an independent competent persons report, which includes the overlying reservoirs that we expect to receive by the end of the month. That's with the reserve auditor right now. We are working on rolling out the partnership and development for the co-location of the crypto mining, which will lead to early revenues from the state 16-2. We'll have many more ducts coming online in the Williston over the next year. And we're moving full speed ahead on our preparations. Our goal is to take the cash flow that we're getting from the Williston and grow more fully, from the Paradox drilling program to grow the underlying assets as reserves or as resource are moved into reserves. And certainly we've been able to do that with the first well. We'll grow through resource additions, and we're always on the lookout for accretive acquisitions, but they must be a right fit. Above all, Donald, as we've talked about, it's a constant attention to the core values, responsible stewards of our investors' capital and responsible stewards of the environment. And I'll leave it at that. I'm sure there'll be questions.
Colin, that was comprehensive. Fantastic. Thank you so much. Let me kick it off by asking you about hedging. You intend to hedge, but you haven't yet. So what are the benefits and costs of hedging the portfolio? That one's from me.
Well, look, I think it's a great time to be hedging. You're correct. We have not hedged any of the volumes to date. So all of our Williston volumes are unhedged at the moment. But now that we're layering on debt and we'll have a significant level of production, it is the appropriate time to hedge a portion of our production, really to lock in and secure funding to be paying down debt, and especially to lock in the funding for the Paradox. So, people should expect that we will be hedging out a fair portion of the volumes. And obviously, in this type of environment, I don't mind having some upside, but we think we can lock in a lot more cash flow than we expected when we negotiated this transaction a few months ago.
So hedging is about hanging on to your money. It's hanging on to the wins that you've gained.
It's ensuring funding. Yes, it's ensuring funding for our plans and to make sure our balance sheet is bulletproof.
Okay. Risks which remain to be managed. You were mentioning it very briefly. I thought that was an interesting thing just to explore for a minute.
Yeah, absolutely. I think we take a very measured approach to risk. We used government funding to drill the first research well here. We spent months analyzing the cores and the logs. We've paired it with our seismic, which matches very perfectly, ties in perfectly with what we found underground. We took very small steps and did a lot of analysis before we began spending the larger sums of capital here. So we'll continue to do that. I think, we still need to understand the evolution of the fluid mix. This well had substantially more gas than we thought. It had the oil we knew would be there, but more gas as well. Other wells in this region haven't been so gassy. So there are still things that we need to understand around water production, fluid mix, pressure. Pressure can always be tricky to deal with when you're drilling in a high pressured environment. We've demonstrated that we can do it. We've done it very successfully now twice. But it's something to manage. And on the flip side, it's a huge opportunity because it provides great reservoir drive.
Okay, and now we have several questions from the London Southeast website from all the people who've joined us tonight just to hear you speak. Kenny McKeever, let's start with Kenny. He gives us a bit of an example. The annual estimated run rate from Williston is 1,759 barrels of oil per day. The State 16 2LN well, that's 2,100, gives you a total of blah, blah, blah. At $70 per barrel, that would produce gross revenues of around 98 million US, he says. So here's the questions we finally get here. What's your best estimate of net cash flow to the company arising from gross revenues after deduction of overheads, loan interest, and tax?
Okay, so I think it's important for us not to get ahead of ourselves. I'm not trying to dodge the question, but we have the CPR coming out here shortly, and we purposefully haven't released cash flow estimates from the Paradox. We will once we have the CPR in hand and we can forecast on something that has the third-party verification. I think Kenny's calculations are good from the Williston side. Certainly, you can look at what we've released in the CPR there, because the Williston assets have been published and they're on our website. You see 75% margins plus. So OpEx at $13, oil that's around the $90 range right now. So there's a lot of margin that you get from the Williston wells. Similarly, on the Paradox side, we've said this before, the OpEx there is in the mid-teens. And we fully expect those to be highly profitable wells with rapid paybacks. So until we release cash flow estimates, and we'll do that, I don't want to get more detailed than that, but I think people can work up their own calculations based on the production numbers we've given and the OpEx that we've put out there.
Okay, Kenny goes on to ask, or to say, 3 more wells in the Paradox in 2022. How much do you estimate those will cost to bring those online? And would you expect all 3 to be producing by Q1 2023?
Yeah, so we certainly would want to tie all 3 in and be producing at that point. So first and foremost, yes, these are not delineation wells that won't have cash flow associated with them. They very much are designed to be producers that will be tied in and be able to kick off a fair amount of cash flow to fund the next year's program. In terms of costs, these wells right now, we think they'll cost about $8 million per well, but we are 75% working interest in 2 of them. And in the one to the south, we will probably partner with a neighboring owner and split that well 50-50. So, costs all into the company are probably closer to $16 million or so.
Okay, so you have already partnered with on some of those wells?
So we already have a 25% non-op owner in the Paradox. We've always had that, and we expect them to participate going forward. If they don't, certainly we would step up and do the remainder. To the south, we're looking at forming a partnership with a company that's there and drilling across both sides, so longer lateral instead of drilling on just one section, to be able to drill across 2, and it'll be a bigger well, but also we're excited about the potential there.
Would there be sufficient cash in the company to drill and bring those 3 wells into production?
Yep,
or would you have to raise additional funds? This is a big question.
Yep. So this is, and this is obviously why we've taken the pain up front here to bring this cash flow in, because these Williston assets now will kick off over $25 million of EBITDA a year. And that's when we modeled it at $70 oil for this year and mid-60s for next year. There's a sufficient amount of cash flow to do what we want to do here in the Paradox over this coming year.
Okay, talking of the pain, David Johnson and Gordon Tuff were both frustrated with the latest share placing because the latest raise has diluted their shareholding, pushing them both into a loss. And let me hit you with their quotes. Interested to learn how diluting my shareholding by nearly 20%, while at the same time reducing its value by 1/3, was part of a carefully crafted strategy. That's David. Gordon says, do you think you'll be pulling this trick again, stopping existing holders from selling out and buying back in at 5p? I've been forced to hold the dip. Discuss.
Okay. Well, certainly one of the reasons I'm on here tonight, just after the placing, is to make sure I reiterate to everybody why we've gone down this path. I'm the single largest shareholder in the company at this point, and this is a decision that I and the board did not take lightly. It's a step backward today in order to take 2 or 3 steps forward in the near future. And it's similar to what we did last year when we initially funded the first Bakken wells, the first Williston wells, and the Paradox drilling program. It's not something that we do lightly, and I understand the dilution and the pain we've taken up front. But on the flip side, for 12 million pounds in equity, so call it $16 million, that's going to generate, if we hedge this, over $40 million of future cash flows after the debt is repaid. Okay, so it's hugely accretive. In one swoop, we are doubling cash flow per share on a diluted basis, and we're tripling current production. And this is all in a low risk, high margin field, a field where today the operator has just bought another 4,500 barrels and other upside for $273 million. We think our valuation is extremely attractive as compared to that. And it gives us an underpinning for this company, proved assets that paradoxically, yes, the Paradox is not reflected accurately in our value today. The proved assets should be. And as we can go through this process of releasing the CPR and developing the program there, I do believe we will have a more accurate reflection of that.
So for long-term holders, this is good news.
For long-term holders, and again, of which I'm one of them, this was the right step forward for the company. It's difficult to do, and at the same time, it gives us a huge amount more running room than we had a month ago.
Fantastic. Colin Harrington, thank you so much. That was absolutely illuminating. Great slide pack. I thoroughly enjoyed that. Thank you so much for joining us tonight.
Thanks, Donald. Much appreciated, and thanks everybody for watching.